He joined Mastercard in 2005 and is now General Manager for the Czech Republic and Slovakia. Mr. Pavel Javorsky.
Thank you. Okay, so I will kindly ask you for switching on my presentation. It seems that I am going to perform most probably the most controversial presentation on this evening. So please, or I'll be pleased if you will bring at least something positive from that. And I am going to say a short disclaimer. Today, this presentation is not the official presentation of Mastercard, either Europe or international. This is presentation of Pavel Javorsky, who was a long-time trader in financial markets, who was a banker, who was a salesman, and trying to survive the financial markets day by day, hour by hour, for a long time on this market. And now I would like to share my experience with you. It's up to you if you bring something from this short presentation. So I'm going to talk about interesting theory which was developed or observed by Ralph Nelson Elliot in 20s, 30s last century by close observing the Dow Jones Industrial Average, and this person, finding the principle, was able to predict relatively well the financial crisis in 1929 and even the turning, the spin of the market behavior. And I would say a lot of people, a lot of chartists, even not admit that they are using these techniques. They simply have it in mind when they are deciding on investments. And I know it's not exact economic science, so that's it. What is it about? Elliot observed that the market is moving in one large wave up, and then it's corrected in some correction. And this impulse wave, which is wave up, is usually subdivided to another 5 ways. When first is impulsive, then second is corrective, third is impulsive, then is correction, and then the last impulse. And then the shape is slightly reverting, and then it goes in 5 waves down, 3 waves up, and down. So if it would be true, it would be very nice, and then we would be knowing where we are on the market, we would be able to predict the future. For those who would doubt it is possible, I am showing you, for example, Financial Times Stock Exchange Index over the last 5 years, and you can see very nice develop 5 ways up, where the fifth wave is quite nicely underdeveloped or subdivided to another 5 ways, and then there is a correction. Even more, I'm showing some other 2 indexes, German DAX and Dow Jones Industrial Average, with the same period of time. I try to put it on the same values or same axis, and you can see that market is really somehow developing according to this theory. And what is most important, that in principle this theory says that the fundamental factors doesn't play so much importance compared to psychology of the market. That means that there are the investors or traders are human beings, and these people are watching the situation either with the black or pink glasses. So we had a pink glasses for a relatively long time. Currently, we changed our glasses to the black one. Now back to the theory. The theory is quite interesting. It is somehow reflecting the Fibonacci sequence, Fibonacci numbers. So for example, there is one wave up, one wave down. These are Fibonacci numbers. In total, 2 waves, Fibonacci number. These 5 waves up, or the number 5 is Fibonacci number 3 is Fibonacci number, total is number 8 is Fibonacci number. And then in impulse we have in another lower degree of the fractal we have 21 impulse wave or 89. Everything is Fibonacci numbers. The ratio between two Fibonacci numbers tends to be golden mean, which is 1.618 or 0.618. Also, usually market is not always in this ideal shape. It is or market. If there is a more strength, more fundamental strength in the market, then market tends to subdivide into lower degrees, and then we call it so-called extensions. And most frequently, extensions appears in a third wave or in a fifth wave. And into contrary, after a long movement, the last fifth wave is not able to perform the full fifth wave pattern, and then it tends to shrink to the diagonal triangle, and which is normally followed by very strong move down. Also, after strong moves or before strong moves, the corrections are getting quite, I would say, complex or irregular, and in most cases they tend to the triangular formation, irregular formation. Described, I would say, 35 pages, so there's no time for further explanations. But I would like to stress that also this fractal is quite very well related to the golden spiral, and golden spiral appears in a nature as a galaxy shape, as shells, as nautilus, or other things. So now go back to the markets. It was just basic for some conclusions of this. So now let's have a look on a Dow Jones Industrial Average over last 30 years, because to know where we are on this pattern, it is very important to have a long history of the market. So here we can see that we can see how deep the crisis is today. And it seems to be stronger than the internet crisis. But I know that on Dow Jones Industrial Average, the impact of internet crisis was not so strong as the Nasdaq. But here, just for illustration, you can see the crisis in 1987. To have an even better view on the market, then I included 108 years history of Dow Jones Industrial Average. Here I am showing the crisis in 1929. Here you can see the crisis 1997, internet crisis, the current crisis. But to see the crisis, or you cannot, in a long term, you cannot observe the market in absolute values. You have to measure it in eyes of investor, and investor is losing percents normally, so it is better to show it on logarithmic scale. So same picture, just price axis is on logarithmic scale, and here I am now able to see how the crisis in 1929 was strong compared to existing market movement. So existing market movement is relatively standard, normal declining of the market, which is followed after long-term growth. And because we know that our economy came from dark age, we have a good reason to think that we are rather at the end of the pattern, not on the beginning. So let's say that decline in crisis 1929 was, let's say, wave number 3. Then the total or absolute low in this century was the wave number 4. And let's build the Elliot wave theory from this point. So you can see very nicely subdivided five waves in first impulse wave. Then you can see nice ABC correction in a second wave. Then large growth in a third wave. The third wave tends to be really very strong and so on. We can also see nice trend channels here. Here, it's not crisis, but let's say it was the recession from 1965 till 75 or even till 80s. Then we can see another progress. So if I would be pessimistic, I could say that we can find relatively good reasons to think that the market move here really reached the long-term cycle, the fifth wave, and then considering that we are on logarithmic scale, and maybe I'm returning back to the principle. Let's imagine that we were here, then we have a good reason to think that we can expect something like ABC, a huge declining, which normally goes to the wave number 4 of the previous degree, so to this level. So if I return back to the current picture, in practice, it would mean we could go in Dow Jones Industrial Average terms, we could go to level 1000. And I'm not going to be, this is really quite aggressive hypothesis, but it is what Elliot wave says, that's only. Then I'll try to use another tool. Let's have a look on the same picture. So the red line, the red development, it's the same picture. Dow Jones Industrial Average over last century. The same crisis can be seen here. But in a blue line, I put my question. What was the price of the stocks, the Dow Jones Industrial Average, in real money, in gold? So I divided Dow Jones Industrials by gold prices. And I found very interesting peaks here, or very interesting development. I found that in 1929, there was a peak. In 1965, there was a peak, which, if you remember, I marked this as a end of the growth. And then, surprisingly, the peak is not in 2008, but peak happens already in year 2000 or 1999. And Jesus Christ, my stocks in real money already are down by 80%. And it is in gold. If you will measure it by the basket of commodities, probably we would be even lower. So crisis, or we have a good reason to think or believe that the crisis started already in 1999. And what we see here, this could be only some corrective part. Okay. So now I am going to present you another counting, because Elliot wave is relatively, or this theory is relatively flexible, not flexible, but it's you have more possibilities of counting, of course. So if I would count it as 1, 2, 3, 4, and this wave would be 5, but we see only 1, 2, 3, 4. So now we see only development of wave C of the wave 4, which gives us relatively good optimism. And we can think that for another, let's say, 5 years, so this wave doesn't finish yet. So I expect, first of all, that it will finish. It will bottom within 1 year, let's say. Then we can see another up movement, but still from a longer term point of view, there is no reason for a huge optimism, because we are going to reach the fifth wave anyway, and we will be in very similar situation after 5 years, if we will succeed today. And I call it optimistic scenario with the question mark. And then there is another alternative counting of Elliot waves. When I show that again 1, 2, 3, 4 waves happens up to 1985, and now we are experiencing to 2000 we were experiencing the fifth wave, which is very nicely in agreement real money evaluation and discounting would tell us that again we will return somehow back, or we will be in a sideways. So that means now for another 5-10 years we will see the similar level which we already saw over the last 2 years. Maybe let's go back to this picture. What it says, this real money chart, it says that when the blue line is on a relatively high level, it means that people tend to buy shares and not to go to quality, not to go to gold and so on. Once they change their mind, you see that they completely change all the growth performance. So I think it was relatively aggressive. I know I'm showing you it may continue down and strongly because we are on logarithmic axis. So we can go to level, let's say, 4,000 in Dow Jones Industrial Average Equivalent. Or I can say we can go even to 20,000 in 5 years. Or we can go back to the similar levels we were. We will maybe see the new top, but back today. And now another point of view of very similar things. Now I'm showing you the 3 different indexes, Prague Stock Exchange, since 2007. I'm showing Dow Jones Industrial Average since 2007 and Nasdaq since 2007. And it's interesting how similar they go, each together. The foreign exchange rate and other economical aspects are not so important. The shape is quite similar. So how deep can we go and how long it can take? What I did now with this Nasdaq, I put there another part of chart, and it is Nasdaq crisis since 2008, and I calibrate the top before the crisis started. I calibrate on the same level, on 100 level to each indexes, and now you can see that again the way how investors react in panic is very similar to the current development. So these levels, the Prague Stock Exchange is not that surprising, and it can indicate you how deep we can continue and maybe how long it can take. The spending. So we are in approximately, at petrol stations in a half of the movement, and spending at different US areas. And this advisor group is analyzing these processed transactions, and they can do it in real time, and they have great capability to have feeling what is happening now, and they create the set of reports which is called spending public by state, the consumer spend, and what we do, we release those data with time advantage, so you can know what the data will be. I think there is one month's time advantage for that. So I'm not saying that everything what I showed, which is scaring, will happen, but I see that Elliott wave theory, or I say that Elliott wave theory see the clouds, and I would be careful. Thank you.